just wait outside and cambiamos en inglés. So as I was, I flew here from New York, and today is a very auspicious day for Indians, and I was thinking about a client. So 13 years back, when we started Globista, we were also looking for some family relationships in India, and one particular came to mind. Here was a gentleman, not very well educated, could not speak a word of English, and as the Indian economy started expanding in 1992 and import and export sector expanded, he made a good fortune trading import and export quotas. So from nowhere, he collected a fortune of around 20 million US dollars, which is a large fortune. And then he retired and now started his next phase of life. How do I take care of my family? How do I pay this forward to the next generation? Which he had no experience. So when we met with him some years back, at that time he had already decided that he would take that 20 million, put 9 million in real estate, because that's what everybody in India does, buys a lot of real estate. Puts 9 million in international strategies in US dollar terms, so currency hedging on his own, he decided. And 2 million he would leave it for himself to play in Indian markets. So he did this asset allocation by himself. And then he was smart enough to, work with advisors for his international portfolios. Cutting fast story forward, he was a client of ours. He would call me every 3 months, and our conversations were always at 2 parts. First part, he would ask me a question, and second part, he would give me a suggestion about markets. First question was, what is the value of my portfolio? He didn't care what happens, what Trump is saying, what anybody else is saying, what is the value of my portfolio? And if the value of his portfolio was higher than before, he would happy, smile. If it was down, I could see the sadness in his face, and that's all. That's all he cared about. He didn't care about asset allocations, where we were investing. The second part of the question, the conversation, which was interesting, was he would go to a fortune teller and come back and tell me, my fortune teller has said, my next 2 months are very good, so buy equities in my portfolio. So he would give me advice every 3 months. So the point in all this is, when we invest, at the end of the day, we are thinking about portfolios. It affects humans' life. I realized afterwards why he was worried was he was worried about his wife who had a health issue and how she would be taken care of in case he passes away. So he was always worried about the portfolio value. So human element comes in. And the second element, which is very important, is we all have our biases. For him, his fortune teller was his bias, but we have to take this into account when we think about all of these strategies, etc. So the purpose of my presentation today is to look at all the experience that Globista has had over the last 13 years running strategies and before at other firms, combine it with some of the outlook that Carlos mentioned, and think about it in terms of what are the things which Globista is doing, and share it with you in order to incorporate all of this information. Does it make sense? Does it not? We don't know, but this is what we are trying to do. So first, in terms of the portfolios and ways, and some of this I'll run through very quickly. Of course, we can, as you have seen, we can talk a lot, and we love to talk, but again, I'll try to be brief. So number one, I think a lot of clients underestimate the importance of capital preservation. As we have all seen, that is very, very important. It's very hard to build up a portfolio once it goes down. And it's a human psychology again. When the markets are up 20%, everybody wants to go and say, oh, I had an investment which made 30%. It is not, I would use sexy enough to say, when markets are down 10%, my portfolio is down only 5. It doesn't look that great, right? But that is actually very important. In the longer term, if you see, the compounding really impacts. Diversification, and every country around the world we have seen has a home bias, including in the US, including in Europe. There are some countries which are far ahead. As you go to emerging markets, the home biases are even worse for traditional reasons. Regular rebalancing, avoid concentration, emphasize liquidity. Again, these are just generic terms which we have shared with clients. Again, most of you already know about this, but I just wanted to start with this. But why capital preservation is important is, I just wanted to highlight that. As you see here, if you look at the drawdowns between equities and bonds in the history, the equities could have drawdowns of 45–50%. That could devastate a client's portfolio. And fixed income, although considered to be safe, it could have historically drawdowns of close to around 15%, 20%. Now this does not mean in future this would be the same. We'll talk a little bit about what future would be. But historically, there is potential for large drawdowns in clients' portfolios, and any investment program has to take that into account. One analysis that we really like we did is currently the US 10-year rate is at 152 when we did this analysis. And it is at, a lot of investors over the last 40 years, we have been in a bond bull market. Bond markets have been rallying in the US. What happens if there is a turnaround? And turnaround is even a little bit. So if the US 10-year interest rate goes from 152 to 2%, 50 basis points increase, 250, which is possible. Historically, if you look at the 10-year rates, the 10-year rates have been high. If that happens, what is the impact on the portfolio, the price change? Because of course, if the bond yields increase, the price is going down and your portfolio value is going down. And what you find is in case, even if the bond yields go up by 2–2.5%, you would lose to 20% loss after capital. If the bond yields go to 5.5%, this is the US 10-year, 30%. Now this is, of course, we are assuming an instantaneous increase in yield, which never happens. But think about it. Even if it happens in a year, what is the coupon on the 10-year right now? What is the yield people are making? 150. So yes, 30 minus 150, you might lose 28%. But this, according to us, is a major risk when you look at next 10 years, 15 years of clients' portfolios. The assumptions that people have made, the assumptions that various models have made, the assumptions which a lot of quant models are making is what has happened in the past will continue, and we think this could be a big risk. The other part is, at times we find clients are very interested about timing, and everybody understands, but it's like, I want to time it right. I want to buy it cheap, sell it high. Nobody succeeds it. We are very bad at timing ourselves. But one thing which is interesting is if you see, this is a chart which basically sees what is an annualized return. This is looking at US market for an investor that started investing in each of these years from 1972 to 2015. And if he stayed invested for 1 year, 2 year, up to 44 years, okay? What is his annualized return? Clearly red being negative and green and blue being positive. What you really find is for an investor who started investing and stayed the course, there is no 14-year period. This is the only period. Somebody who started in 2000, they were really unlucky if they started investing in 2000. But even then, after 14 years, it started being positive. So if an investor commits to an investment program and stays, there is no period which gives them negative returns. Yes, this part nobody knows whether you're in 2000, whether you're in 2008. To an extent, that's where our global macro views and our view of the world helps in terms of when to take how much risk. But at the end of the day, having a plan and sticking to it always helps. So now we come to more important questions. These were broad in terms of what is Globista doing and what is our solutions to all these macro issues that Carlos spoke about, right? In terms of cyclical views, also in terms of all the secular trends that he spoke about, nationalisms, etc. So number one, Globista runs currently, we have multi-asset portfolios. We clearly participate on that, and of course, as Iñaki and Carlos mentioned, we have been in emerging market equities for close to around 20 years now. But more important than just talking about this, what I wanted to share here is what client issues we came up with. Most of our strategies or most of our portfolios, we just don't think about it and start managing. More often than not, it's about a client need that we're trying to satisfy. So I'll share more about what the needs came about and what solutions we provided in those situations. We run for the last 11 years, we've been running a multi-asset strategy, what we call conservative. It's a tactical strategy, number one. So as Carlos mentioned, we think the importance of tactical management has gone up, partly because the way fixed income valuations are right now, the way US valuations are, and also some of the secular trends such as nationalism is increasing the importance of tactical management. Number two, a lot of these clients, when we started with, were really focused on how to preserve capital. So capital preservation for these clients was very, very important. And they came to us and they said, this is what we'll be focused on. Another example where it got started was an insurance entity. There was an insurance entity. Essentially, they of course are very focused on managing their portfolios in a conservative manner. They came to us and they said, well, over the last 11 years, you guys have managed the drawdowns very well. You don't lose a lot of money. You're making predictable returns. Could we use this as a cash and a treasury alternative? So in their portfolios, when they hire clients for life insurance policies, they actually have a choice. Do you want to leave it in cash, money market? Do you want to buy treasuries? Or do you want to buy this conservative portfolio? Again, the approximate returns that these clients are targeting is mid-single digits. So I would say 4 to 7% returns on an annualized basis. But their main thesis is we don't want to lose more than 10%. So these are the type of clients or type of entities which are saying we don't want to lose more than 10%. Clearly, the structures could be anything, separately managed accounts. We also are launching flex funds, which allows this to be present in various portfolios. At the same time, on the flip side, there are certain clients who came in and who would be more focused on providing solutions to clients where they are looking at indices, right? So at the end of the day, we can say we don't believe in balanced indices, but the clients do look at it. So there were some entities, again, the way we look at Glovista is we don't deal as much with direct clients or end clients. Our main focus is to work with clients where they need solutions. So we are not a retail entity which will go and talk to thousands of clients. So in this case, there was a client who was an advisory firm, and they came in and said, we need your help in managing a portfolio more tactically, but with few changes. Normally, when you look at multi-asset portfolios of big firms, they always have a bias. Some firms have bias towards geography. So if it's a US firm, they will normally buy US securities. If it's a European firm, they'll buy European securities. Some firms have bias towards asset classes. So if these kind of strategies come out of, say, PIMCO, they would typically look at more fixed income based solutions. If it comes out of more of an equity shop, you would have more of an equity bias. You also have certain firms where they run such mutual funds where they take a lot of leverage. So BlackRock's large fund, Malix, actually uses futures and uses leverage. In our case, these clients wanted, number one, no bias towards any asset class. So go wherever there is opportunity, wherever you think there is value. No bias towards geography, and of course don't use any leverage or don't use any derivatives. These clients are targeting high single digits, but of course the maximum drawdown is close to around 20% because they're invested in funds. And again, the idea is here, I'm giving you some examples of what clients are doing. But more important question, why we have been able to do it, or how we do it, right? And this is a great example. If you look at this chart, this is our, and again, these are actual returns from our strategy, which we have been managing for the last 11 years. The orange line is the line of the fixed income part of our portfolio. The blue line is the Barclays Aggregate Bond Index, okay? So it is the bond benchmark. When you look at these two lines, nothing great, I would not look at it again. But look at this gray shaded line. The gray shaded line is the percentage of our portfolio that is exposed to fixed income over the last 11 years. And if you look at the average, on average it has between 40 to 50%, I would say. Let's say 50% to be on the higher side. So by taking half the exposure in the bonds, we have been able to replicate the index of the fixed income without using leverage. There is no leverage in this. And this is where, again, this is the evidence of the tactical management of the portfolio. So it can add value over a period of time. It doesn't add value all the time, so the recent rally, of course, right? But over a long period of time, you capture majority of the